Hello, students of accounting. In particular, if you are studying FSC 2601, you are on the best platform. I'm going to go through your prescribed textbook and I'm going to share, what is expected of you. So as you can see, I am a tutor. My name is Jackson Impler. And if you wish to get in touch, you can see we've got the WhatsApp number there. So we are going to deal with your chapter 1, and it's an introduction that I'm going to start with. After that, we shall go deep into the lesson to explain everything that is needed. So maybe if you've never done accounting before, there's no need for you to be shaken. That's why we've provided such a platform for you. So what you're supposed to do is just subscribe. I'm looking for people to join, and you are going to have one of your best moments. As a matter of fact, I'm dealing with different types of modules. So it's not just accounting. So we've got other types of modules that we are going to be posting. So if you are struggling, maybe in accounting, or maybe in chemistry, in physics, mathematics, and so forth, then you are on the best platform. So yes, you've seen that they have given to you different types of textbooks as part of your prescribed textbooks, and you can see you've got different volumes for your IFRS. I believe for this module, you're supposed to be using IFRS 8. Maybe let's begin from the definition itself. What does the IFRM, so is it IFRS stand for? That is your international what? International Financial Reporting Standards. Now, I like that. What did I say? International. Start thinking already. International Financial Reporting Standards. Well, it simply means the world where you are coming now, I'm going to welcome you to the club, and I'll say, welcome to the club, my dear. So what does this mean? It simply means you are going international, as an accountant. You can be employed one day in Beijing in China. You might be employed one day in Amsterdam, in Netherlands, or you might find yourself, in the backdrops of London, in England, or you can be in Osaka, Zambia, or any part of the world, you see? So in other words, there is a certain international criteria. As you can see there, we shall look into evaluating the criteria that is used to report financial statements at international, level. Why is that important? You can find yourself working maybe for Absa Bank, Barclays, Standard Bank, or just in the corporate world, I mean, accounting is in almost every department. So you can work for government, you can be for the private sector, So one now to begin to panel beat you so that you begin to understand that indeed there are certain, reporting standards. So you don't just wake up and start putting up books, papers together. No. There is what is expected. For instance, if you are going to come up with a bank reconciliation, there are certain standards that you're supposed to apply. You want to come up maybe with a financial statement, there are certain, standards that are expected. Now, the good news is those standards are international. So meaning if you learn them in South Africa, you can still apply them in USA. You can apply them in South America and so on. So the IFRS, which is your financial reporting standards, we can look at them, as a set of accounting standards that are going to govern, to show you how you operate They give you like a guideline, as an accountant on how you report on your financial statements. By now, you must know business is expected to give what? To give a financial report at the end of the business day. I'm talking about at the end of a quarter, at the end of the year, So, in fact, I'm going to emphasize when we come to the evaluation of the criterion. So this was developed. I'm talking about the International Financial Reporting Standards. It was developed by what you as accountant as the Accounting Standards Board, which is your International Accounting Standard Board. I'm going to repeat, International Accounting Standards Board. So there's a board, that governs at international level. So they are the one that developed this. So that's why the university has seen it fit that, they present it to you because it's an international thing. So let's begin with your chapter 1, and you start with evaluation criteria. So what type of criteria do you use, to evaluate your financial statement? What type of criterion is in place at international level? So as you can see, understand the objective of financial reporting or financial statements. We've dived deep already into the lesson. They are telling you it is inevitable. It is critical for you as an accountant to understand what is the objective of a financial statement. Why do you present, a financial statement at the end of the year? The answer is simple, very, very simple. You've got different stakeholders who are interested in your financial report. Can I give a simple example? You've got investors who want to inject, money into your project, into your company. But how can they invest finances if they do not understand your financial position? How is this company doing, So you now, as an accountant at international level, you must begin to understand that there is a certain evaluation criteria which is used as you report on the financial statements. So you need to understand the objectives. Why do we present, a financial statement? And I said to you, well, there are a lot of people who are interested in your financial statement. Can I give examples? The owner of the business, they want to know how is the business doing, So if there is no financial statements from January to December, how are they going to gauge how the business is performing, How are they going to know whether they are making a profit or they are making a loss, So take note of that. Next, the evaluation criteria is intended to explain and apply, look at that, qualitative characteristics of useful financial information. I like this word, qualitative characteristics. So it's not just a useless report devoid of substance. So the report that you are going to present, must be qualitative. It must be something with a quality, So it needs to explain and apply the qualitative characteristics of what? Useful information. What type of useful information? I gave you an example. I'm going to use maybe investors. You've got people who come to knock on your business. They are looking for certain type of what? Information, useful financial information of this company. For example, how is the company performing at Johannesburg Stock Exchange, where you have put your security? How is the company, performing maybe in Wall Street, in New York? How is the company performing, So you've got competitors and so forth. So we need to know the financial standing, you know, of this company, but we need useful information on the table in order. For example, you've got external auditors who might come into your business, you know, they come to audit the books. But if they do not, we don't have useful information on the table, how are they going to audit? You see? Next, understand who the reporting entity is. Who is this who is reporting? Is it a qualified someone? Because, I mean, you can't just say, okay, we are a company, then who gave a report? Okay, the report was presented by this person. But who is this person? Okay, let's put, for example, what qualification do they have? Are they internal auditors? Are they external auditors? Who gave? So we need to understand who the reporting entity is, and we are still coming to give more information. Next, understand the underlying assumption in preparing financial statements. What could be the underlying assumption? What are we searching for? Why do we, you know, devote quality time to prepare financial statements? What could be the goal? What could be the purpose? So we shall look into the assumptions, you know, why that becomes important. Then explain. Be able to explain. Don't forget, these are evaluation criterion. Be able to explain and apply the elements of financial statements. So we are still coming. We're going to look into the different elements of financial statements. So we've got different elements that we are looking for as we are giving a report about finances. Next, explain and apply the recognition and de-recognition principles. There are certain principles, you know, for us to recognize this statement, for us to say, we are accepting what you have presented before the board of directors, or we do not recognize this statement where it is lacking certain, you know, international, you know, value to it, international touch. It's lacking. It cannot be accepted at international standard. That's why you've got, you know, to understand the international financial reporting standards. So if those standards, we find that they are amiss, then it's not going to be disqualified. Explain and apply the measurement principles. As I said, we shall look into all this in details. I have prepared everything for you. Explain and apply the presentation and disclosure principles. Then the last one, you must be able to understand the concepts of capital and capital maintenance. So those are the evaluation criterion. By the way, in case you are enjoying the lesson, you can give me a like. So I'm still new on YouTube, so I still need you guys. Please, I want you to join. So please click there, and you must click that anytime we put a video, you'll be able to see all of them. So take note of that. So when we are done, the next part is for us to look into your schematic representation of the conceptual framework. So under this one, I want you now to begin to understand. There are certain things, you see there is financial statements, are a particular form of general purpose financial report. But it's more like there's a diagram that before we come to all this, we start from this part, you know, qualitative characteristics of using financial information. So did you generate, you know, those fundamental enhancing type of information, the useful financial information that is fundamental, something that can enlighten us, to enhance, it's able to bring, it can shed more light, you know, so that when we present this document before the CEO, maybe before the company directors or before the financials and so forth, we don't want a document that is not qualitative. It's not just, there is the qualitative and quantitative. So it's not just the quantity. We are not looking at quantity because you have put 270 pages, but how is the information? Is it fundamental? Did you put information, you've summarized everything maybe in form of graphs, you have put up the pie charts, you have put the Venn diagrams, you have put up the bar graphs, you have put up, the histograms and so forth, that the person, when you are presenting the information, they will be able to see, they will be able to evaluate. After that, the objective of the general purpose financial reporting is to provide what? Useful financial information. So I think by now you're beginning to understand that, okay, you as an accountant, the daunting task that is occupying you is to present, you need to provide useful financial information to the different, we call them what? Stakeholders, you see? So all these things must drive us back to the financial statements, are a particular form of general purpose financial reports that you're going to present. Then you've got reporting entity is required to or chooses to prepare financial statements. So the reporting entity is required to choose or to prepare financial statements. That will take us back to this side. Concepts of capital. You need to understand what is capital maintenance, adopted, in preparing the financial statements that you are going to present and so forth. Then we've got recognition, or before there, let me start from there. The elements of financial statements are assets, liabilities, equity, income, expenses. Please, I have not yet gone in details in some of the stuff that you are seeing because I have already prepared them. They are still coming. So we've got all those things. So don't panic. Maybe to see what is meant by capital maintenance, what is meant by capital. We are still coming into that. What is meant by recognition, derecognition, and so forth. So we're going to look into all those aspects. So I wanted just first to present to you. Now, let's go so that we begin to look into the gist of the lesson. Let's provide ourselves a background. It's important to know how did we come up, into these issues, as you can see, of the international financial reporting standards. Why? I mean, we don't want you to work in isolation or to feel like what you do, you are alone. You belong to the international community. Now, let's begin. What is the purpose of the conceptual framework? Why do you have the conceptual framework? What could be the purpose? Let's start. There's a question asked to you. What are the main objectives behind the worldwide drive for establishing a conceptual framework? So why all over the world they say no, they have to be a conceptual framework from which you are going to work, because you can't just start to say no, there is a certain way you have to prepare books. Just as an example, maybe you are working as a in bookkeeping department. Then say no, you can't just put a book. There is a certain conceptual framework that you're supposed to follow. So they are asking, say, what could be the main objective? What is the main goal? Then the answer, they say, since financial statements are published by a wide variety of bodies around the world, often for a variety of reasons. I have given you some of the reasons, by the way. The investors are in need of those documents. Government might be interested in those documents. They want to know how your company is behaving, because government, remember, political leaders also, they want to poke their nose into your affairs. So you need to understand that financial statements have to be published. We need to understand, how is Vodacom performing? How is MTN performing? How is this company performing, and so forth, you see? So often, for a variety of reasons, different interpretations by both preparers, the people who have prepared the books, and the users of the same books, of such statements, may render them incomparable and lead to a loss of the credibility of the financial statements and the accounting process as a whole. So if you don't follow a certain conceptual framework, a certain standards on how to do your job, it might be, you find it may render them incomparable. You cannot compare them to anything. So they have to be a standard, which you call now as a criteria that you are going to use. The conceptual framework serves primarily to assist the International Accounting Standard Boards, this is the one I was talking about, okay, in developing and revising standards that are based on consistent concepts. So there are certain concepts, certain terms or terminologies that you use. I believe you've come across what they call jargon. Every business has got its own what? Jargon, which they use. So the conceptual framework, we are saying, you need to understand what type of concepts are you going to use in your financial statement? What type of words? Are these assets? Are these liabilities? Are you talking about equity? So there must be a certain, conceptual framework from which you as an accountant, you are going to work from. So the International Accounting Standards Board, this is the mother body. It's an international, in developing and revising standards, because there are different standards which they present. So sometimes they will develop them, then later on they revise them. They make some changes. I think you've seen that. That's why sometimes you might have maybe this is the first one, the second one, the third, the fourth, and so forth. It's because of developing and revising of the standards on the passage of time. In addition, the conceptual framework also assists preparers of the financial reports. Who are these preparers? All of you who are students of accounting. You are the people who are going to prepare those statements. So it's also meant to assist you, the preparers of financial reports, in developing consistent accounting policies for transactions or other events when no standard applies or standards allow a choice of accounting policies. So when you work, you need to have at least something, You can't just be working, you are in the darkness, you don't know where to start from, you don't have any guide. You need to have a criterion that you are going to use as a preparer of the financial statement. So in a nutshell, the conceptual framework, therefore, that's what it does, provides the foundation for standards that you are going to apply as an accountant. So the conceptual framework, therefore, provides the foundation for standards that, one, contribute to transparency, So when you prepare books, you are not preparing for yourself. There will be auditors. You see, you've got the watchdogs who are going to come to ESCOM. You've got people who are going to come and check those papers. Now, did you hide information? No. You need to make sure that your reporting has followed, certain standards, and it will contribute to transparency. You didn't hide anything on the performance of this company. In another word, you didn't give us what? A false report. What we want is the actual information. Next, it strengthens accountability. So we become more accountable and contribute to economic efficiency. So we'll be able to gauge now, how we are performing in terms of the economy. Are we making it or not? While the conceptual framework provides concepts and guidance that underpin the decision the IASB makes when developing standard, the conceptual framework is not just passing a page. Just a minute. Did we go back? Okay, just a minute. It's not a standard. Sorry for that. The conceptual framework does not override, doesn't change, doesn't overtake, any standard or any requirements in a standard, and any revision of conceptual framework will not automatically lead to changes in the standard. What they are saying to you is the conceptual framework is not one of the standards, okay? So it just gives like a platform when you work, what type of concept do we use and so forth. So when the conceptual framework is revised, when it is changed, as was the case in the year 2018, they made some changes. Some existing standards that were issued before the revised conceptual framework will inevitably conflict with the concepts in the revised conceptual framework. So you might find that some of the terms, the way we use them, like you are going to see, I'll give you a simple example, like the definition of assets. So there was a certain way the word asset was defined before. So there is now a revised definition. There's a certain way asset, liability was defined before, then they revised the definition. So you can see that you need to understand that they are able to make sometimes certain changes. They can revise the conceptual framework, the way you use the concept, in another way, the way you use terminologies, it can change. It is expected, however, that such conflicts will gradually disappear as new principles, based standards are developed based on the revised conceptual framework. So you're going to find that later on, the old concept, they will go, because now students will be using the new concept. So you find by the time when they change, some students or some accountants, they don't know that there's a new conceptual framework. So they will be stuck with the former definition of assets. Meanwhile, there is a new definition. The conceptual framework is not an accounting standard, we have mentioned, and does not override any formal accounting standards, such as the international accounting standards. So take note, these conceptual framework, they are not accounting standards or international financial reporting and so forth. Brief history. How did we find ourselves where we are? During 1989, the then International Accounting Standards Committee, which was in place, issued a statement entitled Framework for the Preparation and Presentation of Financial Statement, which was formally adopted. You see, it took a long time. It was only adopted in the year 2001 by its successor body, the International Accounting Standard Boards, which is at work today as a framework. This document was based on the American Financial Accounting Standards Board. So you can see that they started working on the document from the year 1989, but it only became adopted. It started working in the year 2001. So they got the ideas from what was happening in USA. So the financial framework, sorry, again, I need to see how to be adjusting faster. Just a minute, sorry again. We need to go a little bit backwards. There we go. So that we connect you properly. We said, I'll start from where? Let's see. Let's begin from there. It's okay. You can see that during 1989, The then International Accounting Standard Committee, they issued a statement entitled Framework for the Preparation and Presentation of Financial Statements, which was formally adopted in 2001 by its successor body, the International Accounting Standard Board, as a framework. This document was based on the American Financial Accounting Standards conceptual framework. Then, this is now in the year 2004. Let's see what happened in 2004. In 2004, the FASB and the IASB initiated a joint project. They came together to develop a common conceptual framework. So instead of allowing the American to work alone, the European, African, why don't we come up with a common, framework so that it will become an international standard? So that's what they did. So in the year 2004, they came together. So the existing frameworks that we have today are served as a point of departure for the development of the new conceptual framework. So when they are developing, we can look, what did this one document state? What did this one state? Then we come up with something new. So the joint project was to be conducted in a number of phases. So phase 1, phase 2. So there was phase A, objectives and qualitative characteristics, was finalized in 2010 and published as chapters 1 and 3 of the conceptual framework. Are you seeing? So they put up a report, and in the year 2010, they published them. They formed as part of chapters, which is chapter 1 and chapter 3. Then the conceptual framework, 2010, contained the following. So those were the chapters. Chapter 1, the objective of the general purpose of financial reporting. What could be the objective? What are we searching for as accountants? Why must we produce, financial reports, financial statements? So we need to discover the objectives. Number 2, chapter 2, the reporting entity to be added, meaning not yet added, but there is a chapter which is the reporting entity, but this one was there. Chapter 4, qualitative characteristics of useful financial information. Then the last chapter 4, the framework 1999, the remaining text from the previous one. Chapter just a minute. We're still learning this technology. Chapters 1 and 3 replace the relevant paragraphs in the framework for the preparation and presentation of financial statements of 1989 framework. It's like they amended, they made some changes. Although the framework was initially replaced by certain chapters in the conceptual framework, which was done in the year 2010, the International Financial Reporting Standards, and specifically the Order Standards, which is the International Accounting Standard, are still based on the concept contained in the framework. These standards will therefore, in many instances, still refer to the concepts and principles contained in the framework 1989. Now, in case you are lost, you don't know what's happening, they are just giving you a brief history, how we came up, with the different conceptual frameworks. So they are talking about how it started from the previous one, 1989. Then they started having discussions, So guys, why can't we, instead of allowing the American, the European, African, Asian on their own, why can't we work together? So they had to put a document together. That's why today we've got a new one, which is a joint framework, you see, from different bodies. So the joint framework project was suspended in 2010, but resumed in 2012 as an IAS and so forth project. The IASB issued a revised conceptual framework in the year 2018, so just a few years ago. This conceptual framework, 2018, is effective immediately for the IASB and effective for the annual periods beginning on or after 1st January 2020 for preparers who develop accounting policies based on the conceptual framework. So the document is now official. So from the 1st of January 2010, when you have to work, use the conceptual framework that's in the 2018 documents. That's why you might find that your textbooks, they update them because things, they do change. So the revised conceptual framework introduces new concepts. You see, it gives you new ideas, new concepts, new terms, how you apply the terminologies, and guidance on measurement, presentation, and disclosure, and de-recognition. It has also updated the definitions of the elements of financial statements. Those elements like we talked about, such as assets, so they have done some, they have revised them. So look into that actually. So, and recognition, further, it has clarified the concepts of prudence, stewardship, measurement, uncertainty, and substance over form. So we'll see. In fact, we're going to take a short break, then we'll continue. So thank you so much. Thank you so much. Right, so once again, guys, I appeal to all of you, please subscribe to the channel and offer me support. I'm going to do a lot of recording, and I can assure it's going to be awesome. So thank you so much. We'll give you another video. Goodbye. Bye-bye.